Right, good morning, everybody. So, I'm trying to get my YouTube up and running. A little bit of a challenge that somebody gave me. So, if you would do me the courtesy of finding this replay on my YouTube and liking it, subscribing to the channel. I know most of us are using the Zoom, but it does go onto the YouTube for people to watch the replay. And that's my goal for next year is to build that YouTube out. So, do me a favor and help me out. We're in a weird spot at this point. We don't have anything looming over us other than OPEC, and that's next Friday. It's also jobs week next week, and we're going to get some data that has really been missing, so that'll help. Right now, we're looking at spot gamma. Somebody asked me today how I know that the call or the put wall has been moved. Well, you can always compare the picture that I took the day before to the picture that I took today because I take a picture of these levels every day. And so you can compare them. But I get it. Then you have to either have kept the picture or you got to scroll back and find the picture. That's not what I do. I'm just saying that you could do that if you don't have spot gamma. But if you do have spot gamma and you want to know how I do it, I come into here. So on the menu system on the side, it has indices underneath founder's note. Scroll down and you get here to, well, it'll look like this at the time. Historical chart, SPX historical chart. Just click on that and it opens up. And this is all of those levels. Now, I generally turn them off, especially if I take a picture of these levels. That way, we only have the call wall and the put wall. And you can see that it's a flat line. It hasn't moved. That's how I know that the call wall and the put wall hasn't moved. Now, when they do move, I generally take a picture and I add that in the morning when I post everything else so that everybody knows it moved. If I don't share the picture, then they haven't moved yet. Of course, I get that. It's not a great system because, I could just forget to share a picture even though they did move. But there's no change. There's no reason to put a picture out, right? And if you are going to do a picture for yourself, zoom in and use Control Shift C. It'll tighten the box up a bit because it'll pop this element page up. And that way you've got a much more compact image for, you know, for your pictures, for posterity or whatever you're doing with those images. It just tightens it up so you get a better picture. So that's where the call wall, put wall change is found if you're looking for it. Otherwise, just compare today's picture with yesterday's picture. Small caps are still on everybody's focus point. It's headline after headline about small caps. There's a number of reasons for this. The crowded trade, there's just so many reasons. But look, these are junk, right? Low float, penny stock trash, unprofitable companies. There's a lot of things wrong. They're not all bad, but you really want to know what you're doing if you're going to be playing around in that space, right? So just proceed with caution if you're messing around with names in the Russell. For the rest of the market, we're basically flat. The NASDAQ down 0.5%, but the ES is flat. This sort of discrepancy between these two, one of them is going to either play catch up or the other one's going to play catch down. Which is which? They generally run really well together, right? Percentage wise, once we're open on the day, the indexes typically run pretty good together. At least the S&P and the NASDAQ does. So they can both be up 0.5% or down 0.5%. When they're this far off, one is going to balance to the other. I'd say we got to get into the open first, and then we'll see how that plays out. We've got some Fed speakers chipping their teeth today, but other than that, nothing really stands out. We were messing around with this yesterday. And I changed my settings. So I have to come back to that and put it back. Low risk on any impact from the White House. Seems like they're looking for a quiet afternoon too. Looks like a quiet Friday, all things considered. Unless they hit us with some gotcha news or do a data dump, could be a quiet afternoon. Okay, the SPX closed at 68.94. It's just below this big bar at 6,900. If we get over that hurdle, we can get stuck between these two bars, 69.50 and 6,900. But we're not above that yet. Right? Got to get through that. Way overhead, the 7,000 marker, you can see it's almost double the size of these others. All this is likely to change by next Friday because we're going to get into OPEC. But for now, that is the resistance that's over our head, all those calls. The concern is that when we get there, they're going to monetize those calls. Basically, there's going to be a lot of call selling at those levels. And call selling is going to be a downward pressure. It doesn't mean we're going to go down, but if you have something pressing against the top of the market trying to push it down, it makes it harder to go up. So while I'm pointing this out and saying there's opportunity for us to see some call selling, don't read that as bearish on its own, just that it would be harder to stay bullish. Was talking to somebody about bias yesterday. You know, the candles are great. Don't get me wrong. I'm a price action trader myself and I use pivot points. But when price gets to a pivot, like yesterday's high or yesterday's low, you should already have a really good idea what the hell you're going to do with it. It's not like we're just trading lines in the sand and when price gets there, we go long or go short. Where's the bias come from? Whatever's moving the price. Price doesn't move just for the sake of movement. Something is moving price always. It can be headline news. Equities can do it like Roku did yesterday. Bonds, dollar, treasury. We never know. We have to go looking and try to find out why today is price moving. What's influencing price? If it's equities, it's very likely you'll find it on sites like this. This is the broker Momo. So you could find the same news headlines on Thinkorswim or wherever you're getting your news. But if it's equities, it should stand out. There'll be headlines like crazy. Um, Yesterday morning, it was all this doubt about the AI spend, and we seen the Mag 7 was soggy because everybody was questioning how much money they had been spending and whether or not they could recoup it. And so you never know. You got to look around. But the bias is going to have to come from something other than the candles because we're trying to identify why is price moving. Could be headline news or options flow on the day. Of course, we won't see that at 7:30 in the morning. So you have to be willing to at least look around and try to find why the heck are we moving? No guarantee that you'll actually find it though, huh? I did have to restart my Thinkorswim at the last moment, so just a second. We'll use the trading view while we wait for that to load. Looking at names that are in the NASDAQ, 14 names are down 0.5% or more. And in the S&P, 7 names are down 0.5% or more. Semiconductors really stand out as being down this morning. Looking at names that are up this morning, only 4. So 4% of the NASDAQ is up at least 0.5%. And it's more staple stuff, right? Consumer non-durables, beverages, non-alcoholic. Yay. Apparel, footwear. That's not going to get it done. All right, just because the call wall and the put wall didn't move doesn't mean we don't want to update our levels, because the volatility trigger, the zero gamma, those can move. Those get updated. So we got a really nice push yesterday. You see that candle that had that really big tail all the way down to the 20, back up through all the moving averages, 69.32. Now we're inside of this really big bar. The widening has begun, so we're beginning to put in a type of megaphone pattern here. We are no longer narrow range counting, and we are not IX10, because we are inside a whole new bar, and this is the first day inside that really big bar. Now we are resting on the 3-period daily moving average, which is still holding above the 10. We would need to cut the 3, break the 10, probably get under the 20, and drag that 3 down through the 10 to get a bear surge signal. So we don't have that yet. We want to see how the week ends and then what it looks like on the new week. A gap down into Monday would be good. It would be better than a gap up. We don't want to run up to the highs and then gap up at the highs. That's a really bad idea. Want to run up to the highs, get a gap down, and then retest the highs and break out. Yeah, that's the trouble with the stream, right? Is that these blue candles kind of sink into the background of these charts. But it's a good thing we're not trading anything, right? We're just talking. Overnight volume 67,000. The benchmark for us is around 50,000. That's the going rate. So if we're above that, we're doing good. It's not extreme. We're not sitting in the hundreds of thousands. So it was just some decent participation last night. Nothing out of control. Just really, it's good, decent participation. We didn't get a big move in the kill zone. So, we're still not seeing that back yet. It seems to come and go in cycles. We do have a market maker move this morning. They're worried about something. Well, we already went through the news and there's nothing on deck for them to be worried about. And yet they are worried about something. So that's one of the reasons I really like this thing. There are tells that should have given us pause, like lower volume. If they're worried about something, generally they would be sitting out. We would see the lower overnight volume as a lack of participation and wonder why they're sitting out. And they would generally sit out in front of something that they're worried about. Well, they didn't do that. So that's one tell that didn't show up. And then, normally we know what the headlines would be. They would be worried about CPI, PPI, non-farm payrolls, something like that. And we don't have that this morning. So that's another tell that's missing. And yet, because that tag is here, we know that they're hedging this morning. This isn't my opinion. I'm not guessing or assuming that they're hedging. I'm telling you for a fact that they are hedging. We know that they are always hedged. This is additional hedging on top of the hedging they already had. It's like buying additional homeowners insurance because you just heard the report that a tornado landed and it's headed your way, right? So what do? You get some extra insurance. Why not, right? Load it up. Got one coming at you. Thinkorswim is the one that made this up. Well, at least the developers, the guys that created Thinkorswim way back in the day, Tom Sosnoff and his team, they made it up. So if you're on another broker, you won't find the market maker move as a tool, but you can see it. This is today. It's the closest expiring option, and the implied volatility average is 10.72. Well, this is the next expiry out, and the implied volatility is 8.37. When the front expiring option has a higher implied volatility than the next series out, you get a market maker move. That's how you can use your own broker to look and see, hey, are we getting additional hedging today? If you was to Google market maker move, you would find articles that Schwab has because Schwab owns this now. And what they did for those articles is they looked at the 25, 30 articles that Thinkorswim, TD Ameritrade had wrote over the years, and they wrapped them all together into like one article. It's okay. It covers some stuff, but they don't mention futures even once. They do explain what it is, and they talk about what I just pointed out, and they connect it to binary events like an earnings or something like that that can affect a company and how the front end will get traded, and then that'll jack the implied vol up. The thing is, we know that if they trade out of the money on the put side and out of the money on the call side, that it's those two areas that affect the implied vol average. So if they come in and they're hitting a lot on the volume, and we can see they're hitting here and here, here, when they're hitting these out of the money positions, that's what's going to affect that implied vol, and it can raise it up higher than the next series out. So they're going in there, they're hedging this morning. This isn't about moving something. So if it was OPEX, which you beat me to it, but it's a good question. If this was OPEX week, we're going to see market maker move all week next week because they're going to be rolling those contracts out of the front end, and it will be a false signal every day. So from Monday to Friday next week, we can't anticipate seeing the market maker move as they roll out of the front end. I would be surprised if they started already now, since most of these positions were sold to open. And why would they give away the weekend? It's free theta. They could start the roll on Monday. Why not roll Monday rather than on Friday the week before? Right? That's 2 extra days of free theta. They certainly could. They could, right? We can see that the open interest is less than the volume being hit today. So you're absolutely onto something. But if you look at the volume on the puts, it's greater than the open interest. So they're not rolling these by itself because they've already exceeded how much the open interest was. Same with this one here. Volume's greater than the open interest. If they were just rolling, it would be less than the open interest, or at least equal to the open interest, right? So it's a good question. It's a really good question. And next week, we're going to have that issue, which really sucks because I like having my market maker move as a signal of risk. And on OPEX week, we're going to see it every day, which means we won't be able to use it because it's a false positive. So the main takeaway is that when we see this signal, we need to be concerned about some event. Call timeout, take a look around, dig a little deeper to see, is there some news that wasn't on the website? It could be things like an Investors Day event or a big pot stock conference, AI conference, something like that that we just didn't see in the economic news schedule. So it doesn't hurt when we see this sort of a signal to do an additional due diligence to try to find what the heck are they worried about and why are they hedging? Maybe we find something, maybe we don't. But at least we know to have that additional bit of caution. Because if they're worried, we should be worried. At some point, it is going to start to decrease and it will be gone by the end of the day because, well, it's using contracts that expire today. So, it can't live through the end of the day, but it shouldn't even make it to the end of the day. It should start to decay at some point. And when it starts to fall, we know that we've passed the horizon. Whatever the event was is now behind us, and we're going to expect it to disappear. Today's ADR, we were talking ADRs the other day, and for years, the only ADR I had is the one that you see here. You couldn't see previous days. And so I would try to explain to people how amazingly awesome these average daily range lines are, and we couldn't see their value by looking backwards. All they had was the pictures that I would have taken and put into the chat. And then this year, thanks to AI, was able to build a new ADR to be able to shine a light and look back in the past. I've been using these ADR lines for a couple of years, so I'm really comfortable with them because one, I built them, and then two, I've been using them every day for a long time. If you've never really used them, then you really don't know how awesome they are, and you got to learn to trust them, or at least begin to understand what they're offering us, what they're telling us. I mentioned yesterday, if we get to the ADR early enough, we can go to the other side by the end of the day, and that it wouldn't be bullish or bearish. It would just be a function of wave in its price action. So it wasn't much of a surprise that we turned around, started to get the breakout, and work our way back towards the other side. So when they give us something, that's great. When it's something like today, well, they're not giving us anything at this point. We haven't reached the edge. We're sitting in the middle of nowhere, and that's not very helpful. It is worth noting that the lower edge is inside the range that we are, and the upper edge would require us to get a breakout to get there. So it's more likely that we hit the lower one versus the upper one because the lower one is easier to get to. The path of least resistance. We have a very wide channel today, and that's because we had a very large day yesterday. These channels are based on a math formula that looks at the previous day's price action. Today's floor pivot is higher than yesterday. That's bullish. Price opened above it. That's also bullish. We've hit it and stayed above it. That's also bullish. A wide channel implies that if we break out, the breakout does not stick and we come back in again. But we're talking about breaking out of yesterday's range. So just to put that into perspective, cover yesterday's range from its highest point to its lowest point, that's what it's talking about breaking out of. So sure, if we run all the way up and break 69.28 and we were to continue higher, this wide channel says we're likely just to come right back in again. Or if we fall all the way down here and we get outside of the channel, that we come back in again. We said the same thing yesterday with that wide channel, because at the time, that was the widest channel that we had seen all week. And it was indicating the same thing, that if we got outside of the range, we were likely to come back in again. And that's what we did yesterday. Right? We got outside, we came back in. And then, of course, at the end of the day, we got outside and we came back in again. So these channels don't make price do anything. They're just here to help give us some clue as to what to expect if we did get a breakout in price. Because of yesterday's really big range, the S&R lines for today are going to be very far away. Yesterday's halfback is 68.73. It's at the bottom of this CPR channel. R1, 69.63, and S1, 68.52. Wow. Talk about showing your bias. All right, so this is the distance to the first S&R line. And that is the distance to the first R line, right? So the indicator itself is saying it's more likely that we go up than down. If we put those two just on top of each other to kind of get some perspective. This smaller one is how far it says the call side is, or the bottom side is, versus the top side. So the floor pivots indicator is suggesting that it's more likely price goes up than down. Just remember that this indicator doesn't make price do anything, and it's only giving us the math that it sees, and it's all math. That's it. It's not using any other influence like options data, news, headlines, alternative markets, correlations, comparisons, just the math from the previous day's open, high, low, close. All right, our distribution for the week, it really feels like a replay of last week. Maybe we've widened out the second distribution more than we did last week, but otherwise we had a tight consolidation and we're sitting above it, just like we did last week. Now we can break that on the downside and fall back down. We could, but we're going to need some real help with that. We're going to have some negative headlines, some gotcha news, shock and awe, something that really gets the market's anxiety moving to get us below that level today, right? Because this is this week's level. Next week, we got next week's problems. So I don't want to say that we can't get below there, but what's the trigger to get us below that level today? I I don't know. Maybe whatever they're hedging against. Otherwise, there's not a lot to see here. The from this time frame, we can't see that we ran into a bunch of sellers against this level. It really just looks like buyers got exhausted. But we'll check that on another time frame and see if there really was some sellers up here. 10-day, 30-minute volume profile and TPO. The TPO really looks a lot better, but compared to what we've seen in the last month, this is about as good as we've seen it in a long time, really. It's not janky with big distributions all over the place. We got a nice center point and a reasonably decent bell curve. The point of control is where it is, and we don't see that it's going to move anytime soon, at least a week and a half to 2 weeks. If we're going to move it sooner than that, then we're going to need to sit in one spot and really build things out swiftly. And we don't have any indication of doing that at this point. So where is the new point of control going to be? We don't even have a registration yet. No RSVP at all. We do have a new VPOC from yesterday. So if we were to make some moves to the downside, 68.70 looks pretty good. I'm going to just round that up to the nearest point. So without putting any bias into things, we can say that that VPOC is where the greatest amount of trading volume took place yesterday. It's likely that if we go back down into that level, we'll see a lot of traders trading again, either from traders' remorse of yesterday or for some other reason this morning. Okay? So maybe a little bit of a speed bump, certainly a first touch play that if we go down there, we're likely to bounce at least a little bit. Those first touch plays, they're good for around 5 to 7 points. They're certainly putting in a lot of work across the top of the Globex, but nothing down below here. We didn't hit anything down here. They've been putting the work in around this 95 area, 68.95. It's underneath the 69 level. Notice how shallow it is right at the round number. So big front run in front of it and on the other side of it, but shallow right on the line. Kind of calls into question the idea of trading on the round number. Looking at yesterday, we were talking about, did sellers come in? And of course, this part was already after the 4 o'clock close when retail would have already been done. You have to have a larger account to be able to trade in that spot. Otherwise, the bulk of the selling came in right there. So like we ran up into the sellers, which is different than what we were seeing on the other time frame, because it looked like we had run up and just got exhausted and started to come back down. That's different than running into a bunch of sellers and then working through those sellers and pushing even higher. We've got a preview of next week's range. This is only a preview because the range is not set in stone yet. On Monday, when we come back in, it will be set, and then it'll be just like all these previous weeks that don't move. But for right now, it's going to continue to move all day. The gray line is our current price, and the red and the green line are going to continue to expand and contract around that until we get to the close. These ranges are based on two metrics. How much time are we measuring, and how much volatility are we measuring? Typically, it's a 5-day week, and so this week and the previous week, that's what we would expect, 5-day week. So if the range isn't the same and we have the same amount of days, then it must be volatility that's different. The market will contract in front of big events, CPI, PPI, non-farm payrolls, FOMC week. We just did FOMC and we had a narrow week. Next week is narrower than this week. The market is pricing in another hurry up and wait week. And the funny thing is This week was a hurry up and wait week. We knew it was going to be tight and sideways. This week was a hurry up and wait week because it was FOMC. Next week is also projecting to be a hurry up and wait week. We call it that because there's a known unknown. The market can see it coming. It knows, for an example, that next week is unemployment. Lots of employment data next week. So it's a known thing that something's coming, but it's unknown because we don't know what we're going to get when that something gets here. So a known unknown, which is different than an unknown unknown. Because you don't see those coming, they just hit us, right? Like the ship getting stuck in the canal. That was an unknown unknown. So we will revisit this range on Monday and see how we actually closed today. But at this point, the market is suggesting that next week's events are more threatening to it than the FOMC was this week. And make no mistake about it, FOMC, CPI, PPI, those are volatility suppressing events. That's why the range is narrower. Volatility suppressing events. And I get it. If you're hearing me say that and you're thinking that I've been dropped on my head too many times, the first time I heard somebody say that FOMC was volatility suppressing, I thought the same thing. What are you, nuts? Have you not seen price move during FOMC? But they wasn't saying that the event itself, when the announcement is happening, is volatility suppressing. They're saying that the event, when we look down the road and see what's on the horizon, what's coming at us, the markets will begin to go sideways as we get closer and closer to FOMC, CPI, non-farm payrolls, and that's what makes it volatility suppressing. Now, once we actually get the event, well, then it's game on. Not so much suppression at that point. We are 0.5% above the 10-day, kind of the sweet spot. We're not overbought. We're not overextended. That run that we had yesterday didn't even scratch how far we could run. We could take another run of exactly the same size again today, and we still wouldn't be overbought. Of course, we could also just retrace the whole move and put us right back down to the 10-day. Either way, from that perspective, we're not overbought. We're not overextended. We have not moved too far too fast, and it does not owe us any sort of mean reversion or pullback just because of how far we moved. Looking at the weekly, we're only 1.8% away from the 10-week. So also, again, not too far away. We generally hang out more than 2% away from the 10-week, and we're not even back to that typical metric. It's kind of like saying you generally drive 75 on the interstate. If you're only doing 65 right now, then you've got plenty of room, right? You can speed it up a little bit. We're not burning hot. We're not running aggressive. We've got room to the upside, and we still wouldn't consider it overbought. Looking at what's down this morning, chips really stand out as being down this morning because they weren't up that much over a 5-day period, and now we're down. It would be different if we were down after we were already up, say, 10% in a 5-day period, because then we're just pulling back after making a good run. No, we're down this morning, and we weren't really up all that much. Quantum is also down. It's kind of a risk gauge. The Mag 7 up volume is down. It's not good. But really, we don't have a lot that's down more than 0.5%. And that's what we want to focus on, is 0.5%. So nat gas, bonds, chips. Looking at what's up this morning, we also want to use that benchmark of 0.5%. Gold miners, Bitcoin, China, and that's really about it. Financials are close, and we do want banks up, right? There's 3 sectors that really help out when it comes to a risk on day. Tech and finance are 2 of those sectors, so seeing them up is a good thing, but they're not up enough. We need more. Still, it's not just XLF, which is really generic. KRE is what I really like to focus on, and they're up too, just not up enough. So we need more out of financials, but we need the Mag 7. We need tech. So we want to keep our eye on tech this morning. Now, the sectors, generically speaking, tech is tech, but that's really vague. If you can get, cloud computing, expanded tech, which is IGV, uh, communications, try to dial it into something more specific than just generic, quote, tech. Chips would be good, like SMH. So we've got some sectors that are up, and they are helpful sectors like finance, but this isn't going to be enough to get us to break out and run to the upside today. We're going to need something more, specifically like the Mag 7 or some good tech, and we don't have it in here yet. That would be what you want to keep your eye on. I don't think the rising tide scenario is going to get it done, right? We know the Mag 7 can carry the other 493, but I don't think the other 493 can carry the 7. As long as the Mag 7 isn't going down, then it's possible. But if they're going down, the other 493 can't go up. Can't. So we need the Mag 7 to either be flat and sideways or to hop on the bandwagon and take it to the upside. Looking at what we were seeing in breadth, we don't have anything yet. And that's what's really going to need to change, right? So that's what I got for you guys. Be careful, be safe, watch the clock. Have a good weekend. I'll see y'all next week.